In this week's video, we'll review the hard data and the charts to help us answer the question, is the bull market in the final melt-up stage? If you follow the financial markets in any shape, form, or fashion, most likely you have run across Wall Street's latest popular story. The story goes something like this. The stock market has entered the final melt-up stage, which implies that something really, really bad is going to happen on the other end. And it also implies that the bull market is nearing its end. Clients and regular viewers know that we don't mind stories, but we want to make sure that we can validate the story or the hypothesis with facts. So in order to do that, we're going to play melt-up match game. Our game is going to be a simple form of pattern recognition. We're going to look at these charts and we're going to categorize them in one of two ways, either as an irrational and final melt-up look, or a more rational and sustainable trend that looks more like a typical market. So let's start with the chart patterns that seem to fit the story going around Wall Street today, which is the market is acting irrational and it's in the final melt-up stage of the bull market. Given there's very little volatility here, and this looks like a market that we could tell a story about being irrational, that it seems to be going up month after month, this chart here seems to fit the profile. The chart to the left really doesn't seem to fit that profile. It seems to be more of a normal give and take. It's pretty easy to see that the basic pattern in this chart is similar to this chart here. And this chart here looks a lot like this chart and a lot like this chart. We have a slope of a line moving from the lower left-hand corner to the upper right-hand corner, and we have very little volatility in between point A and point B. This chart really doesn't look anything like these charts, but this chart seems to fit the irrational final melt-up stage profile. And the same can be said for this chart here. It's very, very similar to this chart, this chart, this chart, and this chart. We've already noted that this chart really doesn't look anything like the charts with the purple boxes around them. So let's classify the charts with the blue boxes as rational and sustainable looking. It's pretty fair to say this chart here and this chart here, both of them look a lot more like this chart here, and they really don't look anything like the charts with the purple boxes. And the same can be said for the chart in the lower right-hand corner. So from a pattern recognition standpoint, forget our story. We're just looking at patterns. The blue box charts look similar, and the ones with a purple box look similar, which is easier to see if we look at them in isolation. The charts on this page look similar, and they look discernibly different from the charts on this page. So now we've taken the charts, we've made them a little bit smaller so we can get them all on one page. This is one group here, allowing us to ask a simple question. Does the suddenly popular Wall Street refrain of, "This is the final melt-up stage of the bull market," have a factual basis, or is it just a good story? We have a very easy and rational way to test the hypothesis. If this is indeed an irrational and final melt-up profile, if we look at returns going forward from this point here, this point here, this point here, this point here, and this point here, ultimately, bad things should start to happen at some point because this is the final and irrational melt-up stage that would be followed by a bear market. So is this just a good story, or do the facts support the story? Instead of these charts being irrational and having a final melt-up look, the returns looking forward from this point, this point, this point, this point, and this point were very, very satisfying. In fact, 12 months out from this point, the average gain was 12.29%. And if we are to believe that this is a final melt-up look, then we would expect these looks here, which are bullish trends, they're making higher highs. We would suspect, based on the story making the rounds on Wall Street, that these are more sustainable trends. And when we look forward from this point here, this point here, this point here, and this point here, we would get favorable results. Looking at these numbers here in these charts, it's very, very difficult to see how the facts support that hypothesis. These irrational and unsustainable looking trends here, in fact, produced very, very satisfying returns on average. And these more rational and sustainable looking trends here produced very, very disappointing returns on average looking out 2 to 12 months. You may have noticed that there's 1, 2, 3, 4, 5 charts on the top and only 4 on the bottom. There's a reason for that, because one of these charts is 2018, and we can't project 2018 forward. So these numbers here are apples versus apples. It's 4 charts versus 4 charts. And it's pretty easy to see from a pattern recognition standpoint, the present day or January of 2018 looks a lot more like these charts up here that produced very satisfying returns looking out 12 months. And the present day doesn't look really anything like what Wall Street is telling us. Wall Street is telling us that the present day looks a lot like the final stages of the dot-com boom bear market. Having lived through that bear market, when a bull market's about to end, it typically doesn't look like this. It starts to look like this. This is March of 2000 here. Similar situation before the financial crisis. We have some early adopters that see the problems and sell into strength. We don't have any early adopters seeing problems and selling into strength on any of these charts that produced very satisfying returns looking out 12 months. So let's move back to the original set of larger charts. These are the exact same charts we started with. We've just added back the dates and the index levels on the charts. If you know your market history, you know the stock market plunged in August of 2015 and then eventually got off to the worst start in history the first few days of 2016. We're being told that the present day looks a lot like the final melt-up of the dot-com boom. And clients and regular viewers know that we've talked a lot about the difficult and indecisive year that was 1994. So after this period of volatility here, the next year was very, very difficult for a trend follower. And if we're to believe that the bull market's in its final stages, then we would expect the monthly chart of the S&P 500 in October of 2007, this is the peak before the financial crisis, we would expect this chart to look a lot like the present day. If we put green labels on the charts where good things happen next, and then we identify 2018 with a label, it's very, very easy to see that the present day chart really doesn't look anything like these periods here, or the latter stages of a bull market. And it looks very, very similar to these periods here that were followed by very, very satisfying gains looking out 12 months. We've talked about the similarities between 2015, 2016, and 2017 with this period here countless times. And it's very, very easy to see that the present day chart looks a lot more like this relative to this late bull market look here or this late bull market look here. Which brings us back to our original premise. Does price action, high conviction, and low volatility match the nice little story going around that the bull market is in its final melt-up stage? Well, the other question that needs to be asked, is it possible that a profile like this, the profile that we have in the present day, could be the early stages of a long-term secular bullish trend? We already know the answer looking out 12 months. These charts that look very similar to the present day produced very satisfying returns. These charts that really don't look anything like the present day produced very unsatisfying returns. Since the evidence that we've covered over the past 18 months or so tells us to be open to good things happening for a long period of time. Let's single out a few of these charts that look a little bit further out than 12 months. These are two charts that seem to fit Wall Street's irrational and final melt-up story. This chart here, what happened next after point A? Was this the final blow-off stage and really bad things happened next? The answer is absolutely positively no. This is the 1995 quote-unquote melt-up stage. This is the 2018 quote-unquote melt-up stage. This point A is the exact same point in time as this point A. This is June 30th, 1995. This is January 17th, 2018. So this is June 30th. This is June 30th. What happened next was the S&P 500 rallied an additional 180% over the next 1, 2, 3, 4, almost 5 years. Therefore, this gain here, the real world gain after a look like this, in this duration of 5 years, doesn't align with the final melt-up story, telling us in the present day to remain open to better than expected outcomes for a long period of time. And that statement is based on the charts that we have in front of us today. It is not a forecast. So we're being told that we should be nervous about a look like this. This is really the look that we should be nervous about. This is indecisiveness, and this is the jittery look that you get before really bad things happen, like a 50% loss from this point here, which is the same as this point here. So let's look at another chart. Does the theory that good things could happen for a long period of time, or the theory that we're in the final melt-up stage, or said another way, which of those two theories better aligns with this present-day chart of the Value Line Geometric Index, 1978, the present-day January 17th, 2018, here? We know the longer a market goes sideways, we entered this box 35 years ago from this point here. We stayed inside of the box for 35 years. Bottom of the box, bottom of the box, bottom of the box, top of the box, bottom of the box, exact same level as this point here. Top of the box, finally break out 35 years after entering. The longer a market goes sideways, the bigger the move that we can expect to get. Are we extended from this base? Not at all. We're 16% above a 35-year base. How does this chart and this base compare to the final push higher for the average stock in the late 1990s? The average stock peaked in 1998. And instead of being in a 35-year base, the Value Line Geometric Index came off of a much shorter base, almost 3 times shorter, a 10-year base. And instead of being only 16% above the base, the final push higher occurred 77% above this base here. And it occurred 1, 2, 3.5 years after breaking out of the 10-year base. This chart here really doesn't look anything like this chart here. And the longer we go sideways, the bigger the move that we can expect to get, tells us that the present day move could greatly exceed 77%, because 10 years is quite a bit shorter than 35 years. Since our approach is based on the weight of the evidence, let's review some more charts and ask, do they support the final melt-up hypothesis? This is the very rare monthly MACD bullish cross that we've covered on numerous occasions. This type of bullish cross has only occurred 6 times since 1993. One quick takeaway: risk occurs the further you get away from a base. This is sideways consolidation in a base. The further we move away from the base, the higher the probability something bad is going to happen. The further we move away from the base, the higher the probability another base will form or something bad will happen. You can see this chart, which is dated December 1st, 2016. Does this look like we're stretched from a base? The longer we move sideways, the bigger the move we can expect to get. The longer we move sideways, the bigger the move we can expect to get. A move that lasted several years. The longer we go sideways, the bigger the move we can expect to get. This is the chart that we covered in a video last year. This one was dated November 30th, 2016. This is stocks, risk on relative to bonds, SPY relative to TLT. Here's our long-term momentum swing. This is an early stage bullish look. You can see the look in 2016 looks very, very similar to the exact same chart at an excellent long-term multiple year entry point, and really doesn't look anything like the early stages of a new bear market or the latter stages of a bull market. So when we look at the present day chart, does it look like this, or this? The answer is easy. The present day, January 18th, SPY relative to TLT, monthly MACD. This is a strong momentum look here. It looks nothing like this waning momentum look. I could see this, measure it, and put it in a model 1, 2, 3, 4 months before the stock market peaked. This doesn't look anything like this, and this looks a lot more like this. 1983 to 1985, the longer a market goes sideways, 2014 to 2016, the longer a market goes sideways. This is our nimble barge look. This is somewhat of a bearish head fake followed by a bullish turn. Bearish head fake followed by a bullish turn. That's relatively rare that it happens in such short order, and usually good things happen for a long period of time. So does this chart today, this is dated December 29th, 2016. We reviewed these charts in one of these weekly videos. Have we lost this look on the S&P 500? This is the exact same MACD as of January 8th, 2018. This does not look like a waning bullish momentum look that we should be concerned about. Is it possible that this will start to morph into a more concerning look? Absolutely, positively, yes. But we said the exact same thing in December of 2016. The point of the exercise is we don't anticipate that. And that's worked out very, very well since we talked about this chart in 2016. We'll continue to take it day by day with maximum flexibility. This is what the latter stages of a bull market looks like. It is not bullish conviction. It's confusion. Early adopters are running for the exits here, and the late adopters are still trying to push the markets higher. Eventually, our 50 crosses the 200, and more importantly, the 200 rolls over in a bearish manner. I could see this, measure it, and put it in a model late in the year 2000. The market doesn't bottom until October of 2002. This is our late stage, early adopter selling volatility look. This looks very, very similar to this. The look in January of 2017, we covered these charts in January of 2017. This looks a lot more like this long-term, multiple year bullish turn that occurred in 2003 and the one that occurred in 2009. Therefore, if we were in the latter stages, the last few months of a blow-off top, we would expect the present day 50-day moving average to be looking erratic like this, and we would be avoiding a rollover look like this. Here's the exact same chart with the exact same moving averages as of January 18th, 2018. Right now, this chart from a long-term perspective, the look of this chart tells us that when we get 100% normal and to be expected volatility, we're not going to move like this forever. The odds tell us that the pullback will eventually be followed by a higher high. The normal and to be expected pullback, the odds say with a look like this, that it will be eventually followed by a higher high. which means if we hold during this pullback, then eventually our P&L will reach a new high when a new high is made. None of that's a forecast. We're playing probabilities. When the probabilities start to look like this, then the model would call for some defensive action. Once again, no forecasting day by day. If we want to look at multiple time frames, we covered these charts. This one's dated January 13th, 2017. These all come from past videos. We covered them. They were very, very helpful at the time. This is roughly a year ago. This is the 30-day all the way out to the 275-day. So we're looking at short-term trends and long-term trends. We can see this, measure it, and put it in a model. We can see this, measure it, and put it in a model. A year ago, the trends didn't look anything like this silly string look here. How does the exact same chart look today? Are we starting to see this increased volatility and rollover look? And is blue on the top the fastest moving average, or is blue on the bottom? This is the look we want. This is the look we want to avoid. This is the look that we have on January 18th, 2018. Is it possible that this chart will begin to morph into something like this? Absolutely, positively, yes. And we will continue to take it day by day. If we take it day by day, we can push our ego aside and remain flexible. We have to be like water. If the chart starts to change, then our probabilistic statements and our allocations have to change. If the charts remain the same as they basically have for the past year, then our allocations can remain the same. No forecasting is needed. If you want to go out even further, we've covered this chart. This one's dated December 29th, 2016. This is the 30, 40, and 50 week. All of these are for illustrative purposes only. These are generic moving averages we're using to cover basic concepts. In 2016, in a video, we said, if political problems become a showstopper, if higher interest rates become a showstopper, if a blow-off top becomes a showstopper, the favorable look that we have in hand that we can see, measure, and put in a model will eventually morph into an unfavorable look. We can see this before really bad things happen. We can see and measure all of this before really bad things happen. Chart looked fine in late 2016. How does the exact same chart look today? I think you can make an argument that this looks a lot more like this constructive period in 2004. Stock market rallied for another 3 years, and it looks a lot more like this constructive period here in 2010, and we're still pushing higher in 2018. And this, in its present form, we're not predicting, doesn't really look anything like this late stage look here. So all of these charts that we just reviewed, none of them seem to support we're in the final stages of the bull market theory. And all of them seem to support the theory that we should be open to better than expected outcomes for a long period of time. That also aligns with the match game charts. The present day looks a lot more like these favorable periods looking out 12 months and really doesn't look anything like the late stage chart that produced unfavorable results looking out 12 months. It's going to be very, very difficult to navigate with an unbiased and open mind if this is the results that you think you're going to see in the next 12 months. A loss of 15% versus the probabilistic outcome, which tells us we should see potentially somewhere between an 8 and 12% gain realistically over the next 12 months. That's a 27% swing in expectations. Our expectation is rooted and based 100% in the facts that we have in front of us today. This story of the late stage look really is not supported by any of the charts that we've covered in this week's video. If you want to find more evidence that we have in hand that tells us the present day looks more similar to 1995 then March of 2000 or October of 2007. We'll include a link to this short takes post in the video post this week, and we'll also try to remember to include a link to this post in our Twitter feed. If you scroll down, you can find links to dated posts between December 23rd, 2016 and year-end 2017. All of these posts contain evidence that tells us to be open to better than expected outcomes over the next 3 to 20 years, rather than having an expectation that we're going to have a blow off top and then immediately go into a multiple year bear market. This post also includes a video with dated clips from our weekly videos over the past 13 months or so that also aligns with those previous statements. And one of the great things about studying these historical charts, if we understand that it's possible, within the realm of possibility, that if we're disciplined and we keep our focus on the longer term, when the math allows us to behave that way, we know that if we're able to navigate through 100% normal and to be expected volatility between a point A and a point B that could occur several years down the road, we could capture very satisfying gains. And there's no possible way this chart is going to look like this going forward for the next 5 years. It's not possible. Easier markets, fractals tell us, in the short run, even within the context of an ongoing bullish trend, easier markets are followed by harder markets. Easier markets are followed by harder markets. So we are going to see some volatility at some point. The math, the hard data, and the model will tell us how to handle that. But we shouldn't be surprised at any point in the next 12 to 14 months when volatility returns. We're going to have some givebacks at some point, but we have to keep our eye on the prize, which is way out here. A 5 or 6% give back is very, very small relative to a 180% gain. A 9% give back is relatively small if you have a 30 or 40% gain here and you eventually have a 180% gain. Even the recent small increase that we've experienced in volatility tells us that watching the market too closely or actively participating in any of these bullet points can lead to two major problems. Number one, overtrading. Number two, it can chew up an incredible amount of mental capital, limited mental capital. And when you're running on low reserves of mental capital, you're going to be more prone to make mistakes. We all know now, with the benefit of hindsight, that the stock market has done very well since November 1st, 2016. As noted in this tweet, since November 1st, 2016, there have been 127 red days within the context of an extremely strong trend. When we're fortunate enough to have extremely strong trends, we shouldn't be chewing up much mental capital at all during these 127 trading sessions, because we're going to hit some points where we have to watch the market more closely. The math, the data, and the model, the hard evidence will tell us when we need to pay closer attention. But the only way we can do that properly is if we head into next week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.